Something is happening right now that should be on the front page of every newspaper in America. But it is not because the implications are so severe that almost nobody wants to acknowledge what it actually means. 5 major countries spread across 3 continents representing over 2 billion people and 15 trillion in combined economic output are simultaneously selling United States Treasury bonds. Not slowly, not cautiously, aggressively. In the past 18 months, these 5 nations have collectively dumped over $400 billion in American government debt. $400 billion. That is more than the entire economy of Austria. That is twice the gross domestic product of Vietnam. And it is moving out of United States treasuries and into assets that do not depend on American fiscal stability or dollar dominance. Let me be clear about what this means. United States Treasury bonds have been considered the safest investment in the world for over 70 years. Every central bank holds them. Every pension fund owns them. Every financial institution uses them as collateral. They are the foundation of the global financial system. When major countries start dumping these bonds all at once, they are sending a message. They are saying they do not trust the United States to manage its debt anymore. They are saying the dollar is not as safe as everyone believes. They are saying the era of American financial dominance is ending and the timing matters. This is not happening during a crisis when everyone panics. This is happening now in early 2026 when stock markets are near record highs, when unemployment is relatively low, when the Federal Reserve claims everything is under control. The selling is calculated, it is strategic, and it is coordinated enough that you have to ask whether these countries are talking to each other about their plans. The 5 nations are China, Japan, Saudi Arabia, Brazil, and India. Together, they represent the largest creditors to the United States government outside of America itself. Together, they hold nearly $3 trillion in United States debt, and together they are exiting at a pace that has never been seen before in peacetime. Today, I'm going to show you exactly which countries are selling, how much they are dumping, why they are all moving at the same time, and what this means for your money, your savings, and your ability to maintain your standard of living. Because when the world loses faith in American debt, when the foundation of global finance starts cracking, everyone holding dollars is about to face consequences they did not see coming. Let me start with the biggest player, China. Because what China is doing is not just selling bonds, it is dismantling 70 years of economic integration with the United States. As of December 2025, China holds $759 billion in United States Treasury securities. That makes them the second largest foreign holder of American debt, just behind Japan. But here's what matters. In 2013, China held $1.3 trillion. They have reduced their holdings by $541 billion over 12 years. That is a 42% reduction, and the pace is accelerating. In the past 18 months alone, China has sold $136 billion in United States treasuries. That is more than they sold in the previous 3 years combined. They are not trimming positions. They're executing an exit strategy. Why? 3 reasons. First, geopolitical tension. The relationship between the United States and China has deteriorated dramatically since 2018. Trade wars, technology restrictions, Taiwan tensions, military posturing. Every escalation makes China more vulnerable to having their treasury holdings frozen or sanctioned. They saw what happened when the West froze Russian central bank assets after the Ukraine invasion. China does not want to give America that leverage. Second, de-dollarization strategy. China has been building an alternative financial system for years. The Belt and Road Initiative, the Asian Infrastructure Investment Bank, currency swap agreements with dozens of countries, digital yuan development, all of it designed to reduce dependence on the dollar. Selling treasuries fits perfectly into this strategy. Why hold dollars when your long-term goal is to make the yuan the dominant currency in Asia? Third, domestic economic needs. China's economy is slowing, real estate sector collapsing, local government debt exploding, youth unemployment at record highs. They need capital at home to stabilize at their economy. Selling treasuries and bringing that money back to China makes sense when domestic problems are severe. But here's the critical insight. China is not just selling treasuries randomly. They are buying gold, massive amounts of gold. In 2023, the People's Bank of China bought more gold than any other central bank in the world. They added over 200 tons to their reserves. In 2024, they continued aggressive purchasing. And in 2025, the buying accelerated even more. Why does this matter? Because gold is the ultimate hedge against dollar decline. If you think the dollar is going to lose value, You sell dollar-denominated assets like treasuries and buy hard assets like gold. China is betting that the dollar's dominance will end within the next decade, and they are positioning accordingly. The numbers tell the story. China's gold reserves have increased from 150 tons in 2013 to over 2,250 tons today. At the same time, their treasury holdings fell from 1.3 trillion to 759 billion. That is not coincidence. That is strategy. And here is what makes this dangerous for America. When the second largest economy in the world systematically exits your debt market while building an alternative financial system, other countries pay attention. They start asking whether they should follow China's lead. They start questioning whether holding dollars is safe, and once that doubt spreads, the selling accelerates. Now let me show you Japan, because Japan's situation is completely different from China, but the result is the same. They are selling. Japan is the largest foreign holder of United States treasuries. As of November 2025, they hold 1.2 trillion, but at their peak in January 2022, they held $1.29 trillion. They have reduced holdings by approximately $90 billion over 3 years. That might not sound dramatic compared to China, but Japan is America's most loyal ally. They have supported American fiscal policy for decades. Japanese institutions have been the reliable buyers of treasury bonds when other countries stepped back. If Japan is reducing exposure, that signals something fundamental has changed. The reason Japan is selling has nothing to do with geopolitics. Japan and the United States are close allies. The reason is economics, pure mathematics. For decades, Japan had near zero interest rates at home. Japanese investors had no choice but to buy foreign bonds to earn any return. United States treasuries paying 2% or 3% looked attractive when Japanese government bonds paid zero. But that dynamic has reversed. In 2024 and 2025, the Bank of Japan finally started raising interest rates after 30 years of zero-rate policy. Japanese 10-year government bonds now yield 2.38%. That is the highest since 1999. Suddenly, Japanese investors can earn decent returns at home without taking currency risk or foreign exposure. So they are bringing money home, repatriating capital, selling treasuries, and buying Japanese bonds. This is not a hostile act. This is rational economic behavior. But the effect on the treasury market is the same whether the motivation is strategic or economic. Supply increases, demand decreases, prices fall, yields rise, borrowing costs for the United States government increase, and Japan's selling accelerated dramatically in the first quarter of 2025. They sold $119.3 billion in just 3 months. That is the steepest quarterly drop since 2012. What triggered that? 2 things. First, Trump's tariff threats in April 2025 caused massive market volatility. Japanese investors panicked and sold. Second, Japanese yields kept rising, making domestic bonds even more attractive compared to treasuries. Here's the trap for America. Japan is not selling because they want to hurt the United States. They are selling because it makes financial sense for them. But when your largest foreign creditor sells $119 billion in 3 months for purely economic reasons, it creates a structural problem. Who replaces that demand? Who buys the bonds Japan is selling? The Federal Reserve can step in and buy bonds with newly printed money, but that causes inflation. Domestic buyers can absorb some of the supply, but American institutions are not eager to buy more treasuries when they already hold trillions. Foreign buyers from other countries could step in, but as we will see, they are selling too. Japan's exit, even though it is economically motivated rather than strategically hostile, creates the same problem as China's exit. Less demand for United States debt, higher borrowing costs, more pressure on an already unsustainable fiscal situation. Now let me show you Saudi Arabia, because what Saudi Arabia is doing might be the most significant of all. They are not just selling treasuries, they are breaking the petrodollar system that has supported American financial dominance for 50 years. Saudi Arabia held $135 billion in United States treasuries as of mid-2025. That is down from over $180 billion in 2020. They have reduced holdings by 25% in 5 years. But the numbers only tell part of the story. What matters more is what Saudi Arabia is doing with oil. For 50 years, Saudi Arabia sold oil exclusively in dollars. Every barrel of oil exported required dollar payment. This created massive global demand for dollars. Countries needed dollars to buy energy. That demand supported the dollar's value and allowed America to run deficits that would have crashed any other currency. But in June 2024, Saudi Arabia let expire a decades-old agreement with the United States regarding oil sales. Now they accept payment in multiple currencies: UN, euros, rupees. They are still selling most oil in dollars, but the exclusive arrangement is gone. And the trend is clear. More oil transactions are settling in non-dollar currencies every quarter. In December 2024, Saudi Arabia signed a massive energy deal with China worth over $50 billion. The deal allows China to pay in yuan. That is $50 billion of trade that previously would have required dollar payment. Now it does not. That reduces global dollar demand. And when demand for dollars falls, the value of dollar-denominated assets falls. Saudi Arabia is also diversifying its reserves away from treasuries. They are buying gold, building strategic partnerships with China and Russia, investing in Asian infrastructure, joining BRICS. All of it signals a shift away from dependence on the United States and the dollar system. Why is Saudi Arabia doing this? 3 reasons. First, they watched what happened to Russia. When Russia invaded Ukraine, the West froze Russian central bank assets. Saudi Arabia understands that if they ever anger the United States, their treasury holdings could be frozen too. Diversification protects against that risk. Second, they see the global power shift. China is now Saudi Arabia's largest oil customer. Asia is where growth is happening. Europe and America are stagnant. It makes sense to align with growing markets rather than declining ones. Third, they're angry about American energy policy. The United States became a major oil producer through fracking. American production competes with Saudi production. The Biden administration talked about transitioning away from fossil fuels. The Saudis see that America is not the reliable partner it once was. So they are hedging. When Saudi Arabia breaks the petrodollar system, when they accept yuan for oil, when they reduce treasury holdings, they are accelerating the end of dollar dominance. Because if oil is no longer priced exclusively in dollars, one of the main reasons countries hold dollars disappears. And when that happens, the entire structure supporting American debt becomes unstable. Now let me show you Brazil and India, because these 2 countries represent something different. They are not traditional creditors like Japan. They are not rivals like China. They are rising powers making strategic choices about their future alignment. Brazil held $241 billion in United States treasuries at peak in 2019. As of late 2025, they hold approximately $25 billion. That is a reduction of $36 billion, not massive compared to China or Japan, but significant for a country Brazil's size. India held over $240 billion at peak. Now they hold around $210 billion, again a reduction of approximately $30 billion. Both countries are part of BRICS, the economic bloc that includes Brazil, Russia, India, China, and South Africa, plus new members like Saudi Arabia, UAE, Egypt, Ethiopia, and Iran added in 2024. BRICS now represents 46% of global population and 36% of global GDP measured at purchasing power parity. This is not a marginal group. This is half the world's people and over 1/3 of economic output. BRICS has been developing alternative payment systems to bypass the dollar. The new development bank, their answer to the World Bank and IMF. Currency swap agreements between members. Discussions about a common BRICS currency. None of this has replaced the dollar yet, but the infrastructure is being built. Brazil and India reducing treasury holdings is part of this larger shift. They are diversifying reserves. They are building trade relationships that do not require dollars. They are preparing for a world where the dollar is not the only option. Why does this matter? Because Brazil and India are not hostile to the United States. They are democracies. They have good diplomatic relationships with America, but they are pragmatic. They see the United States running unsustainable deficits. They see political dysfunction in Washington. They see American debt exploding, and they are reducing exposure not because they want to hurt America, but because they think holding too many treasuries is risky. When friendly countries diversify away from your debt, that tells you something. It tells you that even allies do not believe your fiscal situation is sustainable. It tells you that confidence in American economic management is eroding globally, and it tells you that the world is preparing for a future where America is not the dominant economic power. India specifically has been aggressive about this. They increased gold purchases significantly in 2023 and 2024. They signed currency swap agreements with multiple countries to settle trade without dollars. And they pushed for BRICS expansion. They are building the infrastructure for a multipolar financial world where the dollar is one option among several, not the only option. Brazil, despite economic problems at home, is doing the same, reducing dollar dependence. building regional trade agreements in South America that bypass the dollar, strengthening ties with China, all of it points in the same direction, away from the dollar system. So why are all 5 of these countries selling at the same time? Why is this happening now in 2025 and 2026 rather than 5 years ago or 5 years from now? Because multiple factors have converged to create a perfect storm that makes holding United States debt increasingly unattractive. First, American debt levels have reached a point where serious people question sustainability. 36 trillion in national debt, debt to GDP ratio of 124%, $2 trillion annual deficits, 1.4 trillion in interest payments annually. These are not manageable numbers. These are crisis numbers, and foreign creditors see them. When you lend money to someone, you assess their ability to repay. If the borrower keeps increasing debt faster than their income grows, you start worrying about getting paid back. That is exactly what is happening with the United States. The debt is growing at 6% annually. The economy is growing at 2%. That gap is unsustainable. Foreign creditors understand this, and they are reducing exposure before the crisis hits. Second, interest rates have risen dramatically from near zero in 2020 to over 5% in 2023, now around 4.5%. When interest rates rise, the value of existing bonds falls. If you bought a Treasury bond in 2020, paying 1%, and now new bonds pay 4.5%, your bond is worth much less. Investors are selling before rates go even higher, and their losses get worse. Third, the dollar's reserve currency status is being challenged seriously for the first time since World War II. BRICS payment systems, Belt and Road infrastructure, digital currencies, currency swap agreements, gold accumulation, all of it represents efforts to build alternatives to the dollar system. That makes holding dollars and dollar assets riskier. Fourth, geopolitical tensions have increased dramatically. United States versus China rivalry, Russia sanctions, Middle East instability. These tensions make foreign countries nervous about holding American assets that could be frozen or sanctioned. They want diversification to protect against political risk. Fifth, Trump's return to unpredictable trade policy has spooked markets. His tariff threats, his willingness to use economic coercion against allies, his America First rhetoric, all of it signals that the United States is less reliable as an economic partner. Countries respond by reducing dependence. And sixth, alternative investments look more attractive. Gold prices are hitting all-time highs. Asian markets are growing. European bonds offer reasonable yields without currency risk for European investors. Why hold Treasury bonds paying 4.5% when you can buy German bonds paying 2.8% without currency exposure, or Chinese bonds paying 3.5% denominated in yuan? All of these factors have come together at once. That is why the selling is happening simultaneously across multiple countries. This is not coordinated in the sense of countries meeting in a room and agreeing to dump treasuries together. But it is coordinated in the sense that they are all reading the same signals and reaching the same conclusion. United States debt is riskier than it used to be. Diversification is prudent. The time to exit is before everyone else realizes the problem. Now let me show you what happens next. Because when 5 major countries dump $400 billion in treasuries, that is not the end. That is the beginning. The selling creates a cascade effect that makes the problem worse. Here is how cascades work. When major holders start selling bonds, prices fall. When prices fall, yields rise. When yields rise, the United States government's borrowing costs increase. When borrowing costs increase, the deficit gets bigger. When the deficit gets bigger, the government has to issue more bonds. When more bonds hit the market, supply increases. When supply increases without matching demand, prices fall further. The cycle feeds on itself. Let me give you numbers. If the 5 countries we discussed sell another $400 billion over the next year, and if other countries see this selling and start exiting too, total foreign selling could reach $800 billion or more. Currently, foreign holders own about $8 trillion in treasuries. If 10% of that exits, that is $800 billion. Who buys those bonds? Domestic buyers might absorb some, but American institutions are already sitting on trillions in treasuries. They do not want more. The Federal Reserve could buy them. But that means printing money. Printing $800 billion would reignite inflation just when it is finally coming down. If the Fed does not print and domestic buyers do not step up, then yields have to rise high enough to attract new buyers. How high? Maybe 6%, maybe 7%. At 7%, the government's annual interest payment on $36 trillion in debt would be $2.5 trillion. That is more than half of all tax revenue just for interest. At that point, the government faces impossible choices: default, print money massively and cause hyperinflation, or sell pending, so drastically that you trigger a depression. There are no good options once the cascade starts, and cascades are hard to stop. But once momentum builds, once markets start pricing in higher risk, once the narrative shifts from treasuries are safe to treasuries are risky, reversing that perception is nearly impossible. Confidence is built over decades. It is lost in weeks. We have seen this pattern before. Mexico in 1994, Asian financial crisis in 1997, Russia in 1998, Greece in 2010. In every case, the crisis seemed to come out of nowhere. But in every case, the warning signs were visible months or years earlier. Foreign investors selling, debt levels unsustainable, borrowing costs rising, political dysfunction preventing solutions. The United States is showing all the same signs. The difference is that America is the world's reserve currency and the largest economy. When Greece collapsed, it hurt Greece and Europe. When America collapses, it hurts everyone. The entire global financial system is built on the assumption that United States treasuries are safe. If that assumption breaks, if the cascade starts, there's no institution large enough to stop it. Not the Federal Reserve, not the IMF, not anyone. That is why these 5 countries are exiting now. They see the cascade coming. They are getting out before it starts, and their selling makes the cascade more likely, which creates a self-fulfilling prophecy. The fear of collapse causes selling. The selling causes the collapse. Let me bring this down to your level. Your money, your savings, your daily life. Because when 5 major countries dump American debt and start a cascade, the effects hit ordinary people hard. First, interest rates on everything go up. Mortgages, car loans, credit cards, business loans. If Treasury yields spike, all other interest rates spike with them. A 30-year mortgage that costs 6.5% today could cost 9% next year. That is an extra $1,000 per month on a $500,000 mortgage. Buying a house becomes unaffordable for millions of families. Second, inflation comes back. If the Federal Reserve prints money to buy bonds that foreign investors are dumping, that new money floods the economy. More money chasing the same goods and services. Prices rise, your grocery bill increases by 20%, gas goes up, rent goes up, everything goes up, and your wages do not keep pace. Third, the stock market crashes. When borrowing costs spike and recession fears spread, stock prices collapse. Your retirement account, which is mostly invested in stocks, loses 30 or 40% of its value. Years of savings vanish. Your retirement gets delayed by 5 or 10 years. Your standard of living in retirement drops dramatically. Fourth, unemployment spikes. When companies face higher borrowing costs and recession, they cut costs. That means layoffs. The unemployment rate jumps from 4% to 8%. 10 million people lose jobs. If you are one of them, you cannot pay your mortgage. You might lose your house. Your credit gets destroyed. You start over financially. Fifth, government services get cut. When interest payments consume all tax revenue, there is nothing left for anything else. Social Security benefits get reduced. Medicare cuts force seniors to pay more out of pocket. Infrastructure crumbles. Education funding collapses. The quality of life declines across the board. And sixth, social instability increases. When people lose jobs, homes, and savings, they get angry. Political extremism rises. Institutions lose legitimacy. Trust in government collapse. The social fabric tears. Crime increases. Protests spread. The orderly society you have known your whole life starts breaking down. This is not alarmism. This is what happens in every debt crisis when governments lose the ability to borrow at manageable rates. It happened in Argentina multiple times. It happened in Greece in the 2010s. It happened in Lebanon recently. The pattern is always the same: debt unsustainable, creditors flee, borrowing costs explode, economy collapses, society destabilizes. The only difference is scale. When it happens to America, the effects are global. Every country holds dollars. Every central bank owns treasuries. Every company trades in dollars. When the dollar system breaks, everyone is affected. No safe haven exists. No one escapes. Let me pull this together. 5 nations are dumping United States debt at the same time. China has sold $136 billion in 18 months. Japan sold $119 billion in 1 quarter. Saudi Arabia is breaking the petrodollar. Brazil and India are diversifying away from dollars. Together, they have dumped over $400 billion in the past year and a half. This is not random. This is a coordinated response to unsustainable American fiscal policy. These countries see the $36 trillion in debt. They see the $2 trillion deficits. They see the political dysfunction preventing solutions, and they are exiting before the crisis hits. The cascade is starting. Foreign demand for treasuries is falling. Borrowing costs are rising. The deficit is growing. More bonds need to be issued. Less demand meets more supply. Prices fall. Yields rise. The spiral accelerates. You're watching the end of dollar dominance happen in real time, not all at once, not in a single dramatic collapse, but gradually, then suddenly. One country at a time reducing exposure. One treasury auction at a time with weaker demand. One basis point at a time of higher yields. And most Americans have no idea this is happening because the media is not covering it. Because politicians are not talking about it. Because acknowledging it would trigger the panic everyone is trying to avoid. But the 5 nations selling American debt are sending you a message. They're telling you that the foundation of the global financial system is cracking. They're telling you that American fiscal policy is unsustainable. They're telling you that the dollar's reserve status is ending. The only question is whether you listen to that message and prepare, or whether you ignore it until the crisis arrives and preparation is no longer possible. Subscribe now for continuing coverage as this situation develops, because it is developing fast, and the decisions you make in the next 12 months will determine whether you survive what is coming or become another casualty of a debt crisis that everyone saw coming but nobody wanted to believe. 5 nations are dumping United States debt. The cascade has begun. The only question is how fast it accelerates and how much damage it causes before the system finally breaks.